Um, just a minute. Perfect, we're live. So welcome everybody. Thank you so much for joining us today on a Saturday, on a rainy day. It's pretty good in Delhi NCR here. But thanks a lot for joining us today for the Gulaq AMA on the Rebalance update for today. Probably just let's wait for a minute or so. I'm seeing there are people joining and then we'll begin. And please feel free to drop in your questions since it's an Ask Me Anything session. We'll be very happy to take all the questions you've had about Gulaq, about our returns, about financial markets in general and investing. Wait for a minute or so. I'm seeing that. Okay. Let's begin. Vivek would request you to share your screen so that we can take everyone through the presentation first and then we'll jump into the Q&A.
Yeah, let me know if you can see the screen.
Sure.
Is this okay?
Yeah, I think it's loading. I can see it now. Yes, perfect. Okay, so welcome all. Thank you for joining. I have with me Vivek Sharma, who's the investment head at Gulaq. And I myself am a business and strategy manager at Gulaq. We'll be taking you through the July rebalance update. A lot of you are already our subscribers or have expressed interest in our portfolios. So you would be knowing about Estee, about Gulaq, but still we'd like to just quickly run you through the company and our introductions. So the agenda for today is basically we'll be talking about Estee Gulaq, our rebalance update. We will also be answering the question on, currently the markets are at an all-time high. So what should you do? Should you invest? Should you not? We see a lot of investors asking this question. So we'll be addressing that. And in the end, we'll take your questions and answers. Okay. So about Estee, as you know, Estee is a pioneer of systematic investment in India. It was founded in 2008 when SEBI had permitted algorithmic trading in India. So our forte is to make investment decisions using quantitative methods. We have been around for over 14 years, and we've developed leading investment and broking products using analytics and computer science, because of which we also got the NSE Institutional Member of the Year Award in 2019. We run our own portfolio management service, which is PMS for HNIs, high net worth individuals, where we have an AUM, assets under management, of over 1,000 crores. Now let's talk about Gulaq. Back in 2020, when we saw that our products are performing really well, we wanted to see how we can help the retail audience as well. Because till then, we were only catering to HNIs who had a minimum investment of 50 lakhs plus. For retail investors, we thought of launching our retail investment advisory brand called Gulaq. Gulaq again uses the same quantitative algorithms that Estee uses to serve its institutional clients, and we are offering these portfolios to our retail investors on small case. So it was launched in 2020 and we got our SEBI registered investment advisor license thereafter. We have served 4,500 plus subscribers till date in Gulaq. And we follow a multi-factor algo-based investment strategy, which Vivek will be talking about in the subsequent slides. So before that, we could quickly look at the team at Gulaq. As you can see, Sandeep Tyagi, whom some of you might have seen in other webinars, he's the founder and CEO of Estee Advisors as well as Gulaq. He's been a bachelor's in technology from IIT Delhi and an MBA from Columbia Business School. He has 30 plus years of experience in portfolio management, consulting, analytics, and he had also founded Inductis, which he eventually sold off. I'd like to welcome Vivek Sharma, who's the investment head at Gulaq, and he's here to help us with the webinar on the rebalance update today. Vivek has 20 plus years of experience in trading and investment management. He was earlier around 10 years, he was in Futures First as well. And he's done a BTech and MTech from IIT Kharagpur. As regards me, I am a business manager at Gulaq, looking at partnerships, growth, and strategy. I have 5 plus years of experience in consulting, research, and financial services, and I have done my MBA from Indian School of Business. Now, before directly jumping into the PPT, let's just quickly go through disclaimers, which are very important since we are a SEBI regulated entity. So we are a SEBI registered investment advisor. Our registration number is on the screen in case you want to have a look at it. There are certain disclaimers which are very important for you to take note of while investing in the market. Of course, investments in securities markets are subject to market risks. So you should read all the related documents carefully before investing and consult the advisor. Call us up if you have any questions and we'll be happy to answer them. Registration granted by SEBI is in no way guaranteeing performance of the intermediary, or it does not provide any assurance. So SEBI is not providing any assurance of returns to investors, neither are we. The securities quoted in this presentation are for illustration purposes only and are not recommendatory. So please take note of that. Apart from that, our corporate identification number and our registered address is on the screen for you. Okay, so now that the basics are done, I think Vivek, I would like to call you upon to talk about the portfolio approach that we have at Gulaq.
Sure. Thank you, Eesha. So let's directly jump into our portfolio construction approach and how we add value at multiple stages. So I think one of the most important factors which differentiates Gulaq portfolios with anyone else is we don't look at just one or two or most popular factors. We have constructed a library of more than 130 factors. Out of these, some are very, very popular, like momentum, like growth, quality, value. But then we have multiple other fundamental as well as quantitative factors. So this is a library of 130 factors. And then we look at global and local macro factors to analyze the kind of market regime we are in. Because these 130 factors, if we just club all of them, then we are likely to get market returns only. But then we have to figure out that in current market conditions, what are the factors out of these 130? What are the top few factors that are likely to work in these market conditions? And I think that is the major value add we are doing in Gulaq portfolios as to picking certain factors. So just to give you an example, when the markets were rising about 2-3 years back, at that time, momentum and growth were the factors that were really working well. But we had a period of around almost 18 months to 2 years in which markets were almost flattish. It was going up 5-10%, again coming back. So roughly around 18 months, market was not doing anything. And during that time, momentum factor was losing money, whereas quality and value, they gave us very good returns. So during those 18 months, we performed very well as compared to the market, right? So the thing that we are doing here is we are rotating these factors based on the market regime we are currently in, right? This data in India, we have obviously done almost 15 years of back testing, but the similar tests have been done in 6 more countries where we are running our algorithms and we are running these long only strategies. It's only in India that we are offering it to retail customers. Others, it's totally prop that we are running. And yeah, so it's been running in almost 6 countries right now. And because it's purely quantitative, purely rule-based, there's no chance of getting into emotions like fear or greed, which we as investors definitely do get in, right? So these are the most important factors which differentiate Gulaq versus other discretionary funds, right? Like as I mentioned earlier, we look at 130 factors. There's no one factor, no one sector, or no one market cap which is our favorite. So we are totally agnostic. So only based on the current market conditions, if our algos tell us that right now maybe IT, utilities, and FMCG is suitable, and maybe have more large cap allocation and have more momentum and growth factors, this is what gets picked up. So it's totally defined by the machines. Obviously, we are writing the rules, but that's the only role we are playing. We are just refining and improving the rules. But at the end of the day, we do not have any say in specific sector or specific factor, whether those are good or bad, right? Now let's just have a look at our market rebalance update. So in this slide, we have presented the market cap wise allocation. As you can see, earlier large caps were given pretty high allocation, whereas right now in the last 5-6 months, mid cap has really increased. So last 3-4 months when the market has started performing, our allocation to mid cap has suddenly increased drastically, whereas large cap is slightly on the reducing pace. Small cap, again, this specific month, it has been very, very low. Otherwise, it stays around between around 30% plus or minus few percentage points. But I think the major trend is large caps are getting lesser allocations and mid caps are getting really high allocation. This is related to sectoral allocation, and you can see we have compared our June and July weights in these specific sectors to BSC. So you can see that I think we are really bullish on a couple of sectors which are healthcare. In healthcare, we are BSC 500, you get 5% allocation. We have given now 16% allocation. Industrials, we have 36% allocation, whereas IT, right now we have 26%. I think this another change is last 3-4 months. Earlier, we were close to zero only in IT. And in last 3-4 months, we have been having overweight allocation in IT stocks as well. Consumer staples is another sector which we are slightly overweight. And in all of the other sectors, we are close to zero only. In fact, zero only. Materials is another sector which we have some allocation, although it's less than the overall market allocation. This is about stocks. We have had 2 exits in our portfolio in July portfolio, and we have had 7 entries, new stocks, which have come into our portfolio in July. Rest of the ones which are shown in black were there in June as well. There might be some increase or decrease in the allocation to them, but we are continuing with the other stocks. Now let's quickly look at the market top, investing at the market top, and then we'll be ready to take on the questions. So this is a slide that I wanted to share. So you can see that 10 years back in 2013, we were trading at around 5,000 to 6,000 levels, right? We were in that range. And during these last 10 years, we have seen one big correction in which markets, I think, dropped 30 to 40% in that range. There was another correction in 2015 and 16, you can see, where markets, again, I think 15% or so correction, 15 to 20% correction we saw there. And rest smaller corrections of 5 and 10% we keep having almost every year. But the important point to note here is from 5 to 6,000 levels to more than 19,000 right now. This is a growth of more than 3x. So 300% are the total returns that we have generated, markets have generated in overall. And this 300%, if you want to see the year-wise returns, it's given on the right side. But overall, this actually translates to about 12 to 13% CAGR over a 10-year period. So if you are able to grow at 12 to 13% CAGR, and I think all of us are aware that that is what our expectations broadly should be from equity markets, that index would return somewhere around, on an average, about 300% over 10 years. Now, I don't see any reason why next 10 years would be different, right? So I think on an average, we should expect something similar in next 10 years. In fact, my expectations are slightly more than that. And the reasons have been because of the overall changes that have taken place in India, the infrastructure changes, these infrastructure changes, be it physical infrastructure or be it the digital infrastructure that is put in place over the last few years. I think that is going to help us immensely grow at a much more faster pace. And the second thing is the per capita income as well. So per capita income also increased, I think, from around 600 levels to more than 2,200 USD right now. So that's a good enough increase. And at this level of about 2 to 2,500, what happens is it leaves a lot of discretionary spending power in the middle class, and that is what propels a lot of businesses. So I think because of all these changes, my expectations would be slightly better than what we have seen in last 10 years. Again, anything can happen, but that is what broad expectations are. Now, again, looking at 1 year versus 10 year. Now, I think some of the questions were around that right now we are at the top. So should we invest? Should we wait? Again, I think the answer is pretty clear if you are taking a 10-year view, right? So on the right side of this, in this chart, you can see that these are the 10-year returns. These are the rolling 10-year returns. So 10-year period on a rolling basis, what are the returns? So you can see in this average comes out to be around 300, which is about 12 to 13% CAGR. The worst case 10-year return has been about 100%, whereas the best case, it has been 600% as well, right? So I think the broad range in which one should expect 10-year returns should be in that range, which is at least doubling your money in 10 years versus going up to as high as 5 or 6 times overall, right? And the average is 300. But if your view is to invest only for 1 year, now let's see what to expect in 1 year. If you see the rolling returns of 1 year, they are as low as -50, -60% as well, and they're as high as 100%. So over next 1 year period, this is at least, if we go as per data, this is what can happen, that we can see 50% drawdown or 100%. So the idea here is the average here would be around 12% in 1 year return. But the idea here is that over short duration, it's really very tough to predict the markets, and there's a high variation in which you would expect market returns to be. But over 10-year period, even the worst case scenario is pretty acceptable. You would at least get, say, something better than FD at least on a 10-year duration. So it's very tough to take a 1 year view of the market. So if your view is, or if you want to invest any money which is for 1-2 years, have only a very small allocation to equity and much larger allocation to debt. But if your view is more longer term, 10-year, I think then you can safely invest at right now, even at these levels, because what we have discussed in the previous slide, that overall what we should expect on an average is 3x the returns from here. The markets would be trading anywhere between, say, 55 to 65,000. That is the broad range Nifty should be in overall. So so don't take a view of maybe 10, 200, 300 points, because there's a big range, big trend, which would be happening in the next 10 years as well. Right? So, yeah. So, Eesha, from my side, I think I'm done.
Yeah.
We can start taking questions.
Sure. Vivek, just to clarify, this particular slide talks about the market returns, right? The 1 year and 10-year returns that.
Yeah, these are the returns. Yes.
Okay.
The index returns.
The index returns. Got it. Okay. So yeah, we can start taking questions. There are quite a few questions and a few acquisitions, I would say. So let's get into them right away. One question, I see Jitendra Vairagi is our investor, and he has quite a few questions. So I can sum them up and let you know what he's basically saying. He's saying that he's been an investor with us since the past 1 year, and the churn is too high, 60 to 80% on each rebalance.
Right.
He's also saying he's not comfortable with that much churning, because any other momentum or multi-factor portfolio does not have that much of a churn. Another thing he says is, at recent rebalance, the stock prices got surged for 15-20 minutes in the morning, and he ended up paying a few percentages more for buying the stocks. So maybe we could, address all his concerns together, specifically on the churn, and then the other was on the rebalance. What happened with him?
Okay. See, regarding the churn, yes, I agree. We are churning a lot, but that's the strategy we are following. So what we are doing is we are optimizing for the best risk-adjusted returns. Now, we have also tested for portfolios if we reduce our churn or if we reduce our rebalancing frequency. There are multiple ways to do it. We can reduce our churn, we can reduce our look back period, we can reduce our frequency, in which instead of rebalancing monthly, we rebalance quarterly. But what happens is all of them definitely would help us in reducing the transaction cost. It will help us in reducing the churn. There it will help us, but it will also hurt us. The way it will hurt us is our absolute returns would go down and our risk-adjusted returns would also be impacted, right? So this to us, it's an optimization problem, that what do we optimize for? And in these Gulaq portfolios, what we are optimizing for is the best risk-adjusted returns. And this is what we have. Obviously, we have got to pay some more transaction fees. The point to note here is we have accounted for short-term taxes plus the slippages or the transaction costs one needs to bear. So we do take into account whether this specific stock we are entering or exiting, that is whether how much slippages one would encounter based on whether it's a very highly liquid stock or relatively illiquid stock. And based on that, if the slippages are much more than the expected returns, we don't take that. So the point I'm trying to highlight is we are taking into account the slippages, taxes, all of those factors that can in real life impact us, that does impact us. And even after that, this is the best portfolio we have. So
Right.
that's my answer. I think personally, if you ask me, how do I invest? A big part of my portfolio is into these high churn Gulaq portfolios. But then I have some mutual funds and index funds, in fact, which are just long term. I don't touch them at all. But a big part is here. So I have taken a view of keeping it balanced. It's totally depend on investors if they want lesser allocation to these kind of strategies, or in fact much more aggressive allocation. It totally depends on us as an investor. Yeah.
Right. I think it makes complete sense, because what Jitendra is saying is that if we are churning at such a high rate, the only drawback I see there is the high transaction costs, the monthly costs that you have to pay to your broker, and the SEBI charges that are there. Those
I think
charges.
Yeah, the important point here would be if somebody is actually using a full service broker, he would be obviously paying much more than somebody who is using discount broker. So that becomes quite a big factor in overall returns.
Right. And if you're able to produce, if you're, like you said, we're optimizing for risk adjusted returns and not for churn. Because if we start focusing on reducing the churn, then our risk adjusted returns might get affected. So
it will get affected. We have seen that. So it will definitely not only risk adjusted returns, but overall returns also, they won't be as good. We'll still be beating index, but they won't be as good.
Right.
So, yeah.
So what they are paying in costs would be much less as compared to what we are able to achieve by actually not focusing on churn, but on the returns. So we'll be able to make more returns as compared to the costs that they are paying in this kind of a strategy. But then again, it depends on the person, whether they're comfortable with this. Because I see another comment, someone had mentioned that, we are churning so high, it's almost like trading. Is it really investing? And then there was this other question on the fact that there were certain 3 or 4 stocks that were excluded for 1 month. But after a couple of months, those stocks were added back to our portfolio. So what is your take on that? I think the look back period that you were telling me about is something interesting which we could share with the audience.
So first, I'd like to take on the difference. Somebody pointed to whether it's actually trading or investing.
Right.
It's a valid point. I think about it a lot. I think first point that the way I think about it, I think at the end of the day, the profits that we make on monthly, quarterly, yearly basis, those are profits. And I'm really not as concerned, or my bank is not as concerned whether these profits are coming from trading or investing. Right. So that is one thing. But having said that, I think there are clear differences between trading and investing. What is happening here is many people confuse this because we are taking, let's say, short-term calls. right? We are taking our stocks are there for maybe as less as one month. It could be as high as 12 to 15 months, but average would be around 3 to 6 months, right? So the important point here is trading versus investing. Investing, you are always compounding your money. So what happens is, if I put in 100 rupees, I make a profit of 10 rupees. If I take out that 10 rupees and I'm still only using 100 rupees, that means I'm not compounding my money, right? So the important point here is, for long term, whether you are compounding your money or not, which means do not take out money. So your portfolio, let's say you started with 1 lakh, right now it's 1 lakh, say 20,000. If you're taking out the profits, then it's not compounding, and then it's true that it won't really help you. It's not investing then, right? But if you let your money grow and don't take out the profits, then on profits also you are generating profits, and that is what compounding is about, right? So it is actually long-term investing only. And we never, in our just 5-10 minutes back, I was also talking about that, never take short-term calls. So because we are long only, we are not absolute return strategy. So we are always relative to markets. That's what we'll always do. So if the markets are down, let's say 20%, and if Gulaq portfolios are down just by 10%, I'm very happy because I've saved that 10%. I'm already ahead by 10%, right? So that is the difference. In trading, I think most of us, anyone who is trading would expect absolute returns, irrespective of whether the markets are going up or down. You would always expect that even if the markets are going down, you will expect some profit, because obviously you can go short and make money in trading, right? So that's a totally different ball game. This is for definitely for long-term investors, for investors who really don't want to do stock picking on their own. They don't have the interest, or they don't have the time, or they don't have the skill set to do it on their own. Those are the kind of investors I think we are catering to.
Yeah, I think, and I would like to add that, even in case of mutual funds, for example, people, if the same person who's asking the question, or many other investors of ours also might think that if they're investing in mutual funds, it's more for the long term, whereas what Gulaq is doing on small cases is not. But if you think about it, in mutual funds also, the fund manager is constantly reviewing the portfolio composition and is taking those calls at the back end. So it's just that the investors won't be able to see the calls that are being taken. And again, the frequency of rebalancing in mutual funds would differ for each fund house. But over there also, the fund managers are actually rebalancing, just that we are not aware of what is happening at the back end. Whereas in case of small case, if we are rebalancing, people get to know and also take the action. So the final click of the button is in their hands. And they see the churn is high, but we don't really know what is happening behind the scenes in case of mutual funds as well. So it's
I think this is quite important, that not to think of specifically Gulaq small case as a short-term product. This is really not meant to generate short-term profits. It's actually meant for long-term only.
Right. Perfect. The other similar question was, Vivek, on one person had asked that certain stocks of ours were excluded for a month and now they are part of the portfolio again. So what is our take?
See, again, I think I like to go back to the thing that I spoke about, that we are optimizing for best risk-adjusted returns. So in this, what is going to happen is, this is noise. So sometimes this noise affects us positively, sometimes it does affect us negatively. So let me explain you. Let's say you have a strategy in which you're using moving average. So whenever your stock or index goes above moving average, you buy, and when it goes below moving average, you sell. And in those moving average, what is moving average? It's an average of some look back period. So let's say if that look back period is 10 days, so versus another look back period you consider of 100 days, right? So what is going to happen if your look back period is 10 days is, it's a short term look back period. So only a few days up or down move would impact us much more. So that is more volatile, right? So if it goes up, if the stock goes up for 3-4 days, 10-day moving average would also start trending up. Whereas for 100 days moving average, few days movement won't really impact so much, right? So it's the sensitivity. So if we want to reduce the churn, in that case, instead of taking shorter look back period, we would like to take a longer look back period. So that will actually impact and it will reduce the noise. But what is also going to happen is if that signal is correct, let's say if that up move is actually continuing, so that means that signal is correct. So that 100-day look back period will capture that signal at a much later stage than a shorter look back period. So the positive thing to in all of this is जो हमारे portfolios में हो रहा है कि noise, this is noise कि एक month वो चले गए वापस फिर से आ गए, something like that. If that is happening, that is noise, and that is happening because we have maybe slightly relatively shorter look back periods, because there is a positive angle to it, because we have seen all of this in backtest, and the positive angle is we are able to latch on to those trends at a much more faster pace, or if it is not working, we are able to exit also at a faster pace.
Right.
Whereas if we reduce our, let's say, churn by having longer look back period or slightly some other means, what that will impact us is these kind of things will minimize a lot. कि एक month के लिए अगर एक stock आ जाता है फिर निकल जाता है, something like that. So this will minimize, but again we'll miss out because the positive, we'll miss out on the positives, which is if the stock is actually trending, we'll be late to enter. And if the stock has, again, if it is in our portfolio and started correcting, we will be exiting later.
Got it.
So overall, we have to balance it. And what we have seen is in the current portfolio, obviously it's never static. We are always researching how to improve our portfolios, but in its current state, this is the most optimized state in which, yeah, we do have some negatives, which investors have pointed out. That's the noise, but there are upsides also to it. And I think the upsides outweigh the downside. That's what I like to say.
Makes complete sense. So it's a trade-off, and you're saying we have a shorter look back period because we want to latch on to the uptrends and the downtrends in the short term to be able to actually make the profits because of those. If the look back period is longer, the churn could reduce, but then the risk-adjusted returns would also get affected because we won't be able to pick the trends earlier.
Yeah.
Got it. So just now someone messaged that, frequent rebalancing also leads to investors shelling out a lot of tax. Charit Agarwal is asking. So what do you have to say about that?
Yeah, again, we are not asking anyone to invest a big part of anyone's or 100%.
Yeah.
It's these portfolios are meant to add diversification. That's how I see it. So somebody should not invest only in this.
Right.
The way I am investing, as I've told you, a decent part is into mutual funds and most of it is in index funds. And then I have personally Gulaq portfolios. So these are on Gulaq portfolios, I pay short-term taxes, which is higher than what I pay on mutual funds. But even after paying those higher taxes, I'm getting better returns as an investor. And again, in one's portfolio, we should have everything. Even if you see after paying the transaction costs, the higher taxes, Gulaq portfolios are still ahead of most or at least the index. If you just consider the index, yes, you're not paying taxes, you're not paying slippages and all of that fees, but still, in spite of all of these things, we are still ahead, right? So these are two different investment products. I'm not saying one is better than the other, but I think there is a place for these kind of products also in one's portfolio. That's how I'd like to put it. Yeah.
So someone recently asked if we again invest more on the next day or the same day, we will end up buying the same stock which we just sold to adjust the new weight. Okay, how does that happen? If someone's trying to invest more, the person will anyway be supposed to be adding on to the full portfolio, right? So this case should not really be happening.
Yeah, so you'll just be buying whenever you invest more, or in SIPs, you are just buying new stocks. You're not selling anything.
I think what he means is that if, let's say, we had adjusted the weight of an existing portfolio and we asked the person to sell that. The next day, if the person decides to invest more to buy the overall portfolio, which still consists of that particular stock, but at a reduced weight, the person will have to again buy it the next day.
Yeah, they'll need to buy it only, but nothing. There won't be any sell trade in that, right?
Yeah. So he's actually saying that if, let's say, today is the 1st of July and we rebalance the portfolio, there was a stock which had a weight of 10% and we reduced it to 5%. So the person ended up selling that stock. Now, the next day, if the person is investing more, the person will anyway have to buy that stock again because that stock is still part of our portfolio. So first day during rebalance, he had to sell.
Yeah.
Next day, he had to add.
Okay, yeah. So, that is going to happen, yeah.
Can we do something about it, Vivek? Can we probably add, because at the time of rebalance, I see there is an option to add more funds if you want. So maybe on the same day, if the person has the funds available, it could get adjusted right away.
Yeah, right. At the time of rebalance, if you're increasing your overall investments, then those trades would be reduced. Yeah. But if you're deciding to actually add money the next day, then obviously this is going to happen.
This will happen.
Yeah.
It might be a very small amount, but this this is a technicality that is part of the process. Okay, so let me move to the top. There are a lot of questions coming in. Let's start with the very first one. Kamal Book Depot asked, I have invested in Gulaq year 6. I wish to know how much returns should I expect in next 10 years if I am a disciplined investor?
Yeah. So Kamal, see, what we have seen over 10 years, the minimum one should expect is say about 100% returns and the maximum would be 500 or even 600%. Now talking about averages, this comes out to be about 300%, which is 12-13% in that range I think is a fair expectation. Although in Gulaq, we have beaten the benchmark by pretty wide margin in the last 3 years. But I think this my expectation, I can tell you my expectation. My expectation is over and above benchmark if Gulaq can give me 5 to 6% returns. So instead of 12 per annum, So instead of CAGR of 12%, if I am able to get CAGR of 18%, I would be very happy. And this can actually impact over 10 years. I think this will be a very big impact. We can quickly do some calculation and see how big an impact actually it will be.
Yeah, but this is our expectation. So we can't guarantee this. This is what based on what we have seen, that is what we expect. And since we are also invested, me, Sandeep, Vivek, Shalabh, all our team members are actually heavily invested in Gulaq portfolio. So that's our expectation. And, if anything, if we see returns are not going good, we definitely take action as well to see why that's happening. But yeah, Vivek, you're calculating based on our expectation, how much difference it would make.
Yeah. So I think your investment grows by.
Vivek,
sorry, Eesha, you're breaking off. I can't hear you.
Okay. Yeah, I also can't hear you. I'm not sure why. Let me check my internet. Okay, now I can see you properly. I think I'll work. Maybe now it's fine. Can you hear me?
Yeah, I can hear you.
Okay. I think I'm losing you, Vivek, a little. I'm not sure whose net is acting up.
Yeah. So I think that over next 10 years of CAGR, I think I would be pretty happy with that. That is, yeah.
Okay. Sorry, Vivek, I couldn't gather the last few sentences you said. I couldn't hear you. I'm not sure if the rest of the people were able to.
Yeah. So what I was saying is, instead of 12% returns that we should expect from index, my expectation is from Gulaq, if we achieve 18%, I would be pretty happy. So that's the broad expectation I am having from Gulaq year 6, which actually translates to about 5 times the current amount. So let's say your 100 rupees invested right now at about 12% CAGR would be 300 rupees. Whereas at 18%, your 100 rupees would grow to 500 rupees. So 5x the amount actually, right? So that's the difference overall. And that is what I'll expect about 18% CAGR.
And this is with an assumption that the market grows by 12 to 13% CAGR.
Yes.
Over next 10 years. Okay. Okay.
Yeah.
And in this, of course, just to tell the investors that you could see periods of drawdown where few years together, market is just going down or is flat. And then there could be sudden years of explosive growth. So,
yeah, I think
this
is
averaged.
Yeah, this is a good point because last month we underperformed the market.
Yeah.
And I think there were a few questions also around that, what exactly has happened. I think this is pretty normal. This is very normal. What we have seen in the past, if you consider 12 months, out of 12 months, I think roughly around 8 months, Gulaq Gear 6 is doing better than the index, whereas roughly around 4 months in a year, there are definitely few months in which Gulaq Gear 6 is underperforming. Right. And this is about, say, 65%, if I remember that, 65% in terms of 1 month. But if you consider a 3-month holding period, a quarter, then our success rate is 75%. And if you consider even higher 1 year period, then our success rate is almost 99%. Right. And this is not with Gulaq. This is with any active fund. There will be periods of underperformance. There will be periods of outperformance. And many a times these periods of underperformance could be 1 year or even more, right? Fortunately, we haven't seen anything like that, but it can last for longer as well, right? And that's with any good fund, any good mutual fund, internationally or in India, some of the best funds, they outperform the market by around these levels only. It's not that every month or every quarter they'll be outperforming the market. That is just not possible.
Yeah. All the more why it's a long-term product, like someone had asked earlier. So it's not for traders. It's actually for someone who wants to be invested in the markets for the long term.
Yeah.
That's the view by looking at the returns. Okay. Okay. So Brijesh Rajoria is asking, considering that the market is at an all-time high, want to know, will it be better to invest lump sum amount in Gear 6? And if not, how much percentage of corpus to invest now and how to stagger the remaining amount?
Again, there is no clear answer to it. Mathematically, see, if we see the data, the answer is more or less clear. So if we see the data, we have done this analysis some time back. I remember the results were, see, the point here we are trying to do is, if I invest everything right now, and if the market corrects, then I'll be at a loss. Had I done SIP, I would have been better off, right? But if I do lump sum right now, and if the markets keep going up, then I'm better off, right? And what we have to see is, long term, the bias of the markets is obviously towards the upside, right? And how much is that bias? We can see in the data, it's about 70%. So what happens is, if you invest right now, there's 70% chance that market will keep on going up, whereas 30% chance there'll be a decent enough correction and you'll be better off doing SIP. So that's the data. What data says, that you're better off doing lump sum. And the better off, how much you're better off, it's about 70% is the probability that you will end up making a good decision. Again, it's probabilistic only, right? So it's 70-30. But at the same time, if you consider investor mindset, many times we are not comfortable putting everything at one go right now.
Yeah.
That happens almost with everyone. I think it's a good strategy. In that case, what one should do is make a rule-based approach. So if I have 100 rupees as lump sum, if I want to put it in markets, I'll see, let's say next 6 months is when I'll deploy everything. So every month I'll deploy 100 by 6, right? Every month on the 1st of every month, I'll deploy 100 by 6, irrespective of markets. If you're following this, be comfortable that if the market is going up, it was your decision, you own that decision. There are chances that it might work against you. and you have to make peace with the fact that you cannot just time the market perfectly, right?
Yeah.
So that is one approach. Make it 100 by 6 over next 6 months. If the market's correct, you keep on deploying, you will be better off. If the market's correct sharply, instead of 6 months, you deploy everything in 3 months as well. That is a choice you have. So that is one. So if you're not comfortable putting everything in at one go, make a decision that I'll deploy over next 3 months, over next 6 months. It's not a big decision, actually. Frankly, it's not a big decision if you are investing for the long term. If your view is ki 10 years down the line, I want to make 3x to 5x the money. So even if you save a couple of percentage points, it's not a big decision, actually, frankly.
That's true. And what is your take on investing, doing weekly sips or daily sips? Because that is also functionality that is available now in most of the investment products.
Yeah. Oh, again, whatever floats your boat.
Okay, that was my personal question. This question was not there.
There's no big difference.
Okay.
Frankly, there's no meaningful difference.
Hmm.
Again, if you like doing, I know people who are doing daily sips. I know people who are doing weekly sip. The most important factor is doing that sip every month, whether it's like you distribute it over the full month or weekly or monthly. It's not a big decision, frankly. Whatever you like, do it, but put that money every month. That is the most important thing.
Got it.
Again, this is backed by data. See, we have done all of these analysis in the past, and we have seen that there's no meaningful difference whether you do it on 1st or 7th or 15th or 21st or 30th. There's no meaningful difference. Statistically, everything is the same.
Got it. Perfect. Okay, so moving on to the next question by Harshad. He's saying you are showing Rebalance updates here. So what is the point of paying subscription fees if details are disclosed in public?
Yeah, so I think the value add we are doing is not so much in terms of selecting stocks, although that is a value add, but it's not so much in terms of selecting stocks, because last month our top pick, or the stock in which we were most heavily allocated, lost the biggest.
Yeah.
Right. So beware of putting your money like that. Okay. So what happens here is the weights are important. So 1 month, I'm telling you, last month it didn't work out. Overall, in long run, it will work out. So let's say you see this update, you divide your money in equally weighted basis. You can do that. Most likely, you might outperform the market, which is okay. The better approach is when you subscribe to portfolios, you'll get the weights. I think that is the crux of overall the value we are adding. So I'm okay in showing this. If it helps you, I'm okay in showing this list to you every month without weights. If that helps you, you're free to use it. But I'm telling you, the better approach would be, obviously, if you take the weights, because the highest weight any stock could get is about 20% or so. And there are many stocks, at least 3 to 5 stocks, which would be below 5%.
Yeah. Yeah.
Right?
Even 1 or 2% I saw in few stocks.
Yeah. So I think that is much more important than the actual stocks. Yeah.
Okay. So yeah. So Harshad, to answer your question, just the names of the stocks.
I think, I think the way I see it, if we tell you, the more information we share, you become more, you know more about our portfolio. And that is what I want to do here. Whether you are subscribed or not, at least you understand what we are doing. If you like it, then you'll subscribe it. If you don't like it, it's okay. But we want to share as much as we can in these sessions.
Yeah. In fact, Harsha, this was a conversation Vivek and I were having just before the webinar, where I asked the same question that, hey, should we really show the names of the stocks? Because then people would know why will they subscribe. And Vivek was very clear that, if they don't have the weights, how will it add enough value? Imagine you're putting in much higher money in the stock where we are giving just 1% weight. What will happen to the portfolio? So weights is a very important component of what we advise. Okay, then Narendran is asking, can we invest in first 2 to 3 days of the rebalancing update when notified? And if we miss it, wait for the next month rebalancing update or not? This is very important.
See, again, we have done this study as to instead of first day, if you miss rebalancing on the first day, if you rebalance on second day versus third day, so based on the lag, how much does it impact your returns? The interesting insight from that study was I think over first 3 days, it does not really impact your returns. In fact, in a few months, it was also the case that if you had rebalanced on second or third day, you would have gotten better returns. But overall, first 3 days, it's not having much of an impact. But after that, it really reduces your overall returns, right? Even if you have missed, the best thing is obviously you rebalance on the first day. But I think it's not too big a setback if you're rebalancing on second or third day as well. But try to rebalance in those first 2 or 3 days. And if you have missed it, still don't leave it up to I think next month.
Yeah.
अगर आपका 2-3 दिन से भी miss हो गया, but still you rebalance because that expected returns keep going down during the month. So even if you have missed it by 3-4 days, if you're having that much lag, still do it that month. Do it every month is what I would suggest.
And the example of that, we gave in the last webinar also that in the month of May, I think most of our returns came in the second half of the month.
Yeah, there was 1 month, May, June.
Either
yeah,
it was April or May, I think.
It was May, I guess. For the first 15 days, we were just tracking index. And next 10 days, a huge jump in Gulaq as compared to index. Yeah.
So it's important, don't just miss out at all. Even if it's after a few days, rebalance for sure. Okay, so Aman is asking, I want to subscribe any discount. Oh yes, Vivek, I think we haven't shown that slide. So we should talk about that slide for this one. So we do have a discount, Aman, for the month of July. If you want to subscribe to our 3-month or 6-month plans on all portfolios. As Vivek is showing, it's July 20 is the coupon code that you can use to avail a 20% discount on all the portfolios for the first time. And it's valid till 31st of July or the first 100 subscribers, whichever is earlier, the code will expire.
This code will only work if you go to st.smallcase.com. So using this link, only this code will work.
Okay. Then the next question is, Balaji Ganeshan is asking, as you said, you are also investors in Gulaq. Should we expect biased decisions?
Okay.
That's a good question, Vivek. I will take that.
Okay. I'm just thinking this aloud. Why would I want to touch anything in... obviously, I do have my own biases. Eesha has her own, Sandeep or other members have our own biases. Sometimes we like a specific stock, sometimes we don't. And from my side, what I try to do is, because I have traded a lot in first 10 years, I still try to put on these small bets. So sometimes, let's say I like Paytm, I'll buy Paytm with a small amount of money. That's a small, you can call it play money or whatever, which I've kept, which is less than 5% of my overall portfolio, in which I keep on taking these kind of bets. The idea is definitely not to make money. I really don't make so much of money in that. It's just to put some money on what I am thinking about. That's how I do it. I know that if I use my own biases to invest, I won't be doing as well as what I am doing currently. The reason why we are doing quantitative investing is we believe in this thing, that this is a better style of investing. And if I include my biases into it, it won't be as good. Yeah. So because the reason we have invested in it, I really don't want to touch it, right? Because I know this is a better style of investing. It's more hands-off. It does not give me, I don't have to work to select, I have to work to make those rules better, make those algorithms better. But day to day, there is no decision making. And many a times you might be surprised that I really, at times I don't know also what are the results of, let's say, June or July rebalance. Because what I do is I go to the app, I just rebalance it irrespective of whatever the results are. Uh, so I'm not too bothered about, frankly, these stocks, which ones are getting selected. I'm bothered about how my portfolios are performing, the rules and improving all of that. But the output of it, I'm not too bothered about it.
Right, right.
So I
So
think, yeah, that's what we all believe in. This style of investment is a better style of investment. That's why we are doing this job also full time into it. First 10 years, I was a discretionary trader. Now I'm pure systematic investor because I believe this is a better way of doing things. I hope I've answered this question.
yeah, I hope Balaji, your question is answered. So it's a purely quantitative, rule-based, systematic portfolio construction approach that we're following. And as Vivek mentioned, he's spending time in improving those algos, improving the roles and the rules, and not really actually individual stock picking, because that is taken care of the algos that he and the team develops. So no individual bias could really creep in. Okay, now body soul rhythm. Okay, someone's asking, he invested in Gulaq 5 from November 22nd to last year, and it is showing 10% returns as of now. What is the primary lens of ours to pick the small case, and whether SIP or lump sum, what would work in our case? Okay, more of, I think we've covered that, but maybe we would want to just quickly touch upon it.
So, can you please repeat the question?
Sure. The person is saying he's invested since November last year, showing 10% returns. What is our primary lens to pick the small? What is your primary lens to pick the small case? I think he's asking, how do we select the stocks, and whether SIP or lump sum, what works more? So,
okay, I think SIP and lump sum, I've answered this. Lump sum, if you have the money, obviously lump sum is better. But I think most of us are like getting money in our salaries on a monthly basis, and then we invest on a monthly basis. So obviously, if you have the money, invest when you have the money, which is if you have lump sum, invest at that moment of time. Second is, I think the returns, you talked about returns. I think one of the things that one should check is how much fees one is paying, right? Because our fees overall, if you're not getting the discounts, it comes out to be 5,800 for the year. And this should be roughly around, say, 2%. The lesser it is, the better. So if, let's say, somebody is investing 15 lakh, so the fees will be less than even 1% overall. It will be 33 bips, I think, 33 basis point. Versus if somebody is investing, say, 50,000, for him or her, the fees is more than 10%. So I think the fees is fixed. So you have to pick or choose the investment amount. So it should be sufficiently large so that you don't end up paying more than 2 to 3% of AUM, right? So in this case, what this means is maybe around the investment amount should be around 2 to 3 lakhs at least. If you have less than that, you'll be paying very high percentage. In terms of percentage, you'll be paying very high fees. Second is what I've mentioned again earlier, better to be on a discount broker than a full service broker, because again, in case of full service brokers, because we are churning so high, you'll end up paying a good part of it in your brokerage cost. So do that would be first look at the team, the kind of experience the fund manager and the team is having, how long is that? Next, look at the track record of the products from that team. In our case, we have been running a very successful PMS for more than 12 years, which has never lost money. That's an arbitrage product. These products, Gulaq has a track record of more than 3 years now. Our other PMS has a track record of more than, I think it was 5 years now. So that's the kind of track record. we are having, that is one very important thing to look at when you are selecting small case. So don't look at short-term returns of less than 1 year. It won't really give you anything meaningful. So when you're selecting a small case, or let's say if your small case that you have invested in is not performing, looking at less than 1 year returns really doesn't make sense in terms of deciding whether to enter or to exit.
Yeah, I think that also answers the question of Shrikant. Shrikant had asked that he mentioned that he subscribed to 3 small cases, including year 6 in last 2 months. And
Okay.
he invested on the same day, allocated equal funds and all.
Yeah.
However, in Gulaq, he saw that it's highly volatile and the least profitable amongst these 3 in the last 2 months.
Yeah.
So I think what you mentioned really makes sense, because judging an investment strategy only by the short term in 1 to 3 months won't really tell you enough about the strategy or the fund manager.
So
So
I think he would have definitely seen not 2 month returns before he selected those 3 small cases, right?
yeah.
You would have seen at least whatever returns, like we have at least 3 year return. So you would have seen 3 year return and then selected. So 1-2 months is really not, in these kind of products, it's not a fair time frame to actually judge a small case.
Yeah, that's actually a very valid point, that while selecting, if you're not only focusing on 2 months, then why are we focusing on 2 months to gauge the performance for ourselves? So if you're a long-term investor, you need to give it some time. You need to look at it over a period, at least say 6 months or more. Vivek even mentioned a year. But while selecting, you would have seen, if you would have picked up Gulaq year 6 amongst the top 3 small cases of your choice, you would have picked that up only looking at our past 3-year trajectory and performance.
Yeah.
Okay, so Harshad is asking, if I invest more on the small case, aftermarket orders are possible, but not rebalance orders. If small case would allow aftermarket orders for rebalance, it will be a blessing for working professionals. Okay. I think point taken, we can definitely discuss this with them. Although, Harshad, I think the rebalance update is available to you only on the next day morning. So even if, let's say, because we, from our end, if the rebalance is due tomorrow, we are liable to give small case the list of the stocks 1 day prior at night. So even if you get it at, say, 9 o'clock or 10 o'clock in your account, it won't really help you. So that is what I feel, but definitely we can discuss. I think, Vivek, we can discuss.
Yeah, I think this is a good point. We should discuss, because most of these products are meant for working professionals. Yeah. So if something can be done. This is a good point.
Yeah. We'll definitely talk to small case team about this functionality and see if we can get it for you. Okay, now let me look at the other questions. We have taken some of these. Again, invest more in next day. Okay. The answering. Okay. Jitendra is saying the answering style of Vivek sir is so genuine and true to trust. Got my answers. Thank you.
Thanks a lot.
Thanks, Jitendra. Yeah. Shivaraman is saying he recently joined Gulaq. Okay, this is a similar question. He recently joined Gulaq this week. And is it okay to invest lump sum of 1 to 2 lakhs right now, or to do systematic investment plan? I think Vivek has answered that you can very well go ahead and
I think one more point which we haven't touched upon this in this is how much you are investing, as in what's the total portfolio and what percentage of portfolio you're investing in one specific fund.
Right.
So I think as a rule of thumb, one should invest maybe about 20 to 25% of overall on the higher side in one fund. So if somebody has, let's say, a 10 lakh portfolio overall, then that limit is somewhere between 2 to 3 lakh, definitely not more than 3 lakhs in one fund. Right? That is one way. And the flip side, the way to think about in the opposite sense is, whenever you are investing, if in a specific fund, if it is too small, let's say just 1 to 2%, let's say somebody's overall portfolio is 1 crore and he is investing 1 lakh in Gulaq. So it's just 1% of your overall investable assets. then it really won't make a big difference. Even if we double, it really won't make any meaningful impact to the overall portfolio. So the
Right.
way you should do it is at least have, say, when you're starting, maybe have 4 to 5% at least. And if you're really convinced about a specific fund, have maybe on the higher side, maybe 30%.
Hmm. Got it. Because Vivek already answered Dhruva's question. He was asking how much of your portfolio do you suggest us to invest as a portfolio percentage, being an aggressive
Exactly.
investor?
Yeah,
So you're saying between 5 to 30. If you're
it's a
convinced
broad
to
range. Yeah.
go to 30, I think we are almost at 30, I think, all of us.
I think in this, another point is sometimes there are these very big bets. Let's say something like crypto, in
Hmm.
which you expect maybe it will become 20x, 50x, whatever. It's a
Hmm.
big, and on the flip side, there are maybe more than fair chance that you'll lose everything as well. So those kind of investments, if you are doing those kind of investments, I think have maybe in that case have much smaller, maybe about 2%, so that even if you lose everything, it won't hurt your portfolio. But if you do, let's say 5x, 10x of overall, it has some meaningful impact on your overall portfolio. So in that
Hmm.
case, maybe you can think about lesser than five. You should think about lesser than 5%. But otherwise, in the conventional asset classes, I think somewhere between 5 to 30% is what you should be thinking in that range
Hmm.
overall.
So you're saying because crypto is the highest risk, probably the highest risk investment class,
Yeah,
that's like the rest of the classes, you do it in a way that the overall risk of the portfolio is kind of balanced, even if you're an aggressive investor.
yeah.
Got it. Okay, so Oman Kuruvilla had asked, which are the mutual funds Vivek has invested in?
I'll need to check, but it's mostly index funds. Frankly, it's mostly index funds that I prefer because active funds, there are a few. Most of them are tax saving ones, uh, but my favorites are index funds, frankly.
Yeah, even same here. Even I put some of it in index, and then some of the funds which have foreign international exposure is something I personally do. No advice there, but you know,
Yeah, one of the fund house that I really like, I like to point out is Parag Parikh,
that's the best
because
one.
that is, I think, the similar philosophy we follow in Gulaq. The best thing about them is they don't have too many funds. Uh,
Hmm.
and similar to Gulaq, we don't have too many funds. This is just the asset allocation. But if you ask about the equity part, that is stay same in all our portfolios. And frankly, I think we could have done better, at least business wise, if we would have launched, let's say, Gulaq Momentum, Gulaq Growth, Gulaq Value, Gulaq Large Cap, Gulaq Mid Cap, Gulaq Small Cap. All of those are possibilities. And I think as a business, we would have done better, but that is not something we believe in would add value to an investor. And so I think even Parag Parikh, they have similar philosophy. They have very, very limited funds. Only when they feel it would add value to an investor, they would add a new or launch a new fund. Otherwise, they would refrain from doing it.
Hmm.
So that is one fund house I like a lot.
Hmm. Got it. Perfect. Then, okay, someone's asking, has Gulaq team ever held discussion on a rebalance mid-month for whatsoever reason? So yeah, I think I've
I think
discussed that quite a few
we
times.
discuss that quite often. At times, we keep discussing it.
Hmm.
Uh, when Adani news came out, at that time we discussed, we had, I think, some small allocation to Ambuja Cement, if I remember that correctly. Prior to that, also, there were cases when some news came out because of which that specific stock was correcting. Uh, and again, we don't have a strong opinion on it right now, because at times what we have seen both kind of cases, that some news come out and mid-month it came out and the stock kept on correcting, whereas we have seen the other cases also, that it has corrected immediately after the news came out. It corrected heavily for 2 3 days,
Hmm.
but then it recovered back all the losses. So we have had both kind of cases. It's not as per our in our opinion, we don't think that one is more frequent than the other. So if this specific case that if a bad news come out and stock keeps on correcting is more frequent, then obviously it would make sense. But in our experience, we haven't really seen that. So it's not very clear cut an advantage that it would help us, and that's why we are not doing it. But yeah, we keep, as I said, we keep discussing. That's our job, how to make our algorithms better. But it has to be a rule-based approach. It should not be based on our opinion, our view that this stock can correct because of news. It shouldn't be based on that. It should be pure objective criteria. So if we find something which will add value by rebalancing mid-month also, I think we would do it. But as of now, we haven't been able to find anything.
Okay, so Shrikant is asking, I didn't get this question very well. He says, if direct equity through small case is going to give 12% CAGR, what is the difference between mutual fund and small case? I'm not sure if he's referring to your previous.
The thing that we discussed was, I think in index, one should expect about 12% average. Obviously, we have seen the highs and the lows, but the average is about 12%. In active funds, one should expect, say, 3% to 6%. Even that 3% is very, I'm saying it's very tough to achieve, even for us. And in Gulaq, I'm expecting a bit more, 6%. It's still to be seen whether we'll be able to achieve that 6% alpha over long run, which will be phenomenal if we do it. But overall, if one is investing in active funds, be it active mutual funds or small case, I think that is, even if one active fund does well by 2-3%, even that is, I think, pretty good performance, right? So both mutual funds and small cases, each has its own pros and cons. They are both different kind of products, but at the same time investing in equity through, and they are both trying to outperform the market. Yeah, so there are certain similarities, there are certain differences, but I think overall an active fund, you should expect an active fund to beat its benchmark by 2 to 6%. Yeah, and it's not an easy thing to do. We all know the data. It's not at all easy thing to do.
Yeah. Okay, so Bong Voyager is asking, are the Gulaq team members invested in PMS only or Gulaq Gear 6? So I am invested in Gear 6. I don't think I'll be able to invest that much money, which PMS product requires. But Vivek, what's your answer?
I have again invested in only Gulaq Gear 6.
Okay. Okay.
See, this is again, PMS is much more diversified as a product. It has about 60 to 80 stocks in it. Gulaq Gear 6 has about, on an average, 12 stocks. I am a pretty aggressive investor, and that's why I have chosen Gulaq Gear 6 for a big part of my portfolio. That's the reason. It's not that one is better. They are both different. PMS would be more stable.
Yeah.
More stable. Maybe it will give slightly less returns, but again, the risk is also lower. The volatility is lower. I am comfortable with the kind of volatility Gulaq Gear 6 has. That's why I've invested big part. But again, it's personal preference. If somebody wants, there are many investors who know Gulaq Gear 6 is doing well, but still investing in PMS because PMS also offers its own advantages.
Right. And he's asking another question on, is there any difference between Gulaq Gear 6, 5 and Wealth portfolio on the equity part of stocks, or each portfolio holds different set of equity stocks?
So Gulaq Wealth is different, but Gulaq Gear 5, all the gear-based portfolios have similar or exactly same equity part. Gulaq Wealth is slightly more diversified.
Yeah.
So it was meant for somebody who's willing to put in much larger sums of money and is who wants more stable and diversified set of stocks. So Gulaq Wealth would have about 20 stocks as compared to 12 in Gear 6. So Gear 6 would be slightly more volatile, but is expected to give better returns, absolute returns. Here it might be slightly lower, but again, the volatility would also be lower in Gulaq Wealth.
So Sharath is asking how to find out which script was added and removed. Okay, Sharat, you'll have to. So if you're just looking at the list Vivek presented on his screen, that was just the, as he had mentioned, just the list of stocks. But there are weights that we assign, and you'll have to actually subscribe to Gulaq portfolios on st.smallcase.com. That is our URL. Over there, you will be able to, once you subscribe, see the list of stocks along with the weights. And each month we rebalance, that is, we give buy, sell, hold recommendations on our portfolio. So you will be able to see, yeah, this is the
but
list.
this is the list. Actually, these two stocks we have exited,
Yeah,
and the green ones, the red ones we've exited, and the green ones are the new additions to our portfolio.
yeah. This is for this month, but yeah, the
Yeah.
weights will be available only once you subscribe to small case, to Gulaq portfolios on small case.
Yeah.
Okay. Okay, Bong Voyager has a lot of questions for us. He's asking two more things. How do the 3 and 5 year rolling returns look like for Gulaq, and what's the lowest and highest return for 3 and 5 year rolling return? Plus, what is the max drawdown you faced in the last 15 years of back testing of Gulaq Year 6 portfolio? It's very specific to return questions.
Okay. See, I do not have these handy. Obviously, we have done all of this analysis, but I don't remember. I'll be happy to share it. When can we share it? In next month's meeting or earlier? We'll try. But
Yeah.
I've noted down these points. Again, the rolling 3 and 5 year returns that you have asked,
The
because we
lowest
have
and,
been,
sorry,
sorry, the lowest and highest as well of
the
this.
lowest and highest rolling for 3 and 5 years, and also the max drawdown for
Yes.
the last 15 years of backtested data. I think we can get these numbers in the next month's meeting.
Yeah.
Next
But
month's
all of
rebalance.
this, even the rolling ones would be for backtesting data only, because it's been only 3 years that we have been live for, right?
Right.
But we'll be happy to share this in our next monthly meeting.
Right. Sure. Okay, then Sharath is asking, is it wise to have a core portfolio of shares that has maximum weightage? So probably he's mentioning that we have a few stocks which have a higher weightage. Is that what he's trying to ask?
Sorry, can you repeat the question once? I did not
Is it
understand
wise
it.
to have a core portfolio of shares that has maximum weightage?
I think a core portfolio, the way to look at it is having a core and a satellite portfolio is a good way to approach your investments. The way I have done it is, instead of picking, because I don't like to pick stocks, or I do it with very small part of my portfolio. The bigger part, the core part would be, I would say, index funds. And then I have Gulaq Gear 6 overall as the only satellite part. See, if you have the skill set, the time, and the interest to select stocks, to pick those right big caps, then yes, you can do a core set of say large cap stocks in which you have big allocation, and then satellite portfolios. But if you do not have that skill set or time to do it, then I think either you leave that core part to professional investors through mutual fund, small case, or put it in index funds. So yeah, that is the way I would answer. Most of the investors, frankly, more than 90% of the investors aren't able to pick stocks well on their own and hold it on long term. And that is why mutual funds, small cases, all of these products are there. But if you do have that capability, that interest and time, that is a pretty good approach as well. But again, having said that, I've told that it works for maybe less than 10% of the people only. It makes sense for less than 10% of people to do it.
Right. Sure. Okay, so just a quick time check. I think we'll be winding up in another 10 minutes. We have some 7-8 questions left, and we'll try to cover them in another 10 minutes. So, okay, Sahil, I think Sahil's from Small Case. We used to interact. He's saying hello to you and me. He's asking, he has quite a few questions. He's asking, I wanted to know, does allocating to such small positions of 2-3% really have any meaningful impact, given some stocks also have allocations as high as 20% sometimes? He's currently...
Again, we have seen this. We have to have a threshold cutoff somewhere,
Hmm.
right? And what we have seen is if we reduce these allocations and have maybe, then we will be left with say 5, 6, 6, 7, 8 stocks somewhere in that range.
Hmm.
I think returns wise, it really won't make a difference so much, but this helps overall more in the diversification part. It helps in reducing the volatility.
Hmm.
So the- even right now, people find it, our portfolios are volatile, and they are volatile. I agree to that. But if we reduce those few stocks as well, which have lower allocations, it will be even more volatile. Maybe it
Hmm.
won't help us in increasing the returns, but yes, the volatility would certainly increase. So they do provide some value add in terms of making our portfolios lesser volatile.
Makes sense. Makes sense. Perfect. Then another question by Sahil is, which investing factor in your arsenal do you foresee to outperform going forward? Momentum, quality, value, or something else?
Again, you're asking about a personal bias. So I don't know. See, what data tells us is momentum is the best factor. If you allocate to, if you have to pick just one factor, I think it will be momentum. That is clear. But I don't want to rely on it, because what we have seen in last 3-4 months, we have seen good movement overall. But prior to that, for 18 months, market was flat, and during that time, even momentum was losing money.
Hmm.
Right? So momentum was correcting, market was flat, whereas we, I think in that 18-month period, we did about 35% returns in that flattish period.
Hmm.
And why we were able to do it is we did not allocate even, we did not allocate to momentum. Mostly it was to low volatility and value that we were allocating, right?
Hmm.
So if we have to pick one factor, it will be momentum. But again, personally, I don't want to rely on one factor
Hmm.
in our portfolios.
Right. Makes sense. I think that's also our philosophy. So we would want to diversify, at least in the
Yeah.
factors.
Yeah.
Right. Surinder is asking, since family funds are in different accounts, can they use the same subscription to invest in multiple family accounts? I would not like to take a subscription in all three accounts for the same service. I think that's
I understand. I myself have taken subscription for 2 accounts. I couldn't find a way out of it. There's no workaround. So I myself have taken 2 subscriptions. There's frankly no workaround to that.
yeah, you could use the discount codes. Even for me, myself and I made my father invest. So again, another subscription. But Surinder, you could use the coupon code that we have this month, which is July 20, if you want to subscribe to the portfolio through your family's account as well. Okay. Okay, so Shrikant is asking, this is again a feature request, that for rebalancing, if you can discuss with small case team to keep a bracket for buy sell price for each stock. This will really help the investors to avoid fluctuations in returns. Okay, I think he's talking about a limit price there. But all these small case orders are market orders actually. We'll have to really check if this is something that could be made possible given the nature of the product. But yeah, we can have that discussion.
Yeah, let's have this discussion with small case team. It
Yeah.
will help us, but again, I'm doubtful uh, because of the regulations, it might or might not be allowed. We'll need to see whether it's allowed and how
Yeah.
much effort it will take for them to develop this.
Right. And Shrikant, if you try to rebalance on the first day itself, it will really help you because everyone will be in the same boat. So there won't really be much fluctuations in the returns if you invest at the very beginning on the day the rebalance request is coming out.
But I think, Eesha, this kind of not request, but this kind of execution, I know somebody who has invested in our small case portfolio is following, but
Okay.
he's a full-time professional investor. So he has a big portfolio, and he likes to reduce the overall execution cost. So he has done a lot of back testing and seen when to enter, when to exit in specific stocks. And he does this full time actually. and he has developed algorithms around to execute on his own. So that's his full-time job, but he says it helps him execute in a better way. But again, we'll need to see, because for most of our investors, what they expect is just a single click rebalance. They don't want to keep coming back and see whether those orders are executed or not. So yeah, so we can in fact talk to small case to see if this would help and if this is actually possible also or not.
Yeah, we'll have to check. And like you said, for working professionals, I think this is what is there. If someone really wants to do those VWAP and PWAP, all of those things, they'll have to be full-time into the markets.
Yeah.
Okay, Sahil has another question. Is liquidity taken into consideration while selecting stocks to avoid slippages since small case places market orders?
Yes, so I mentioned this earlier as well. Liquidity, we do take into account liquidity as well, and how much slippages one would have while executing these orders. We take that into account and then select our portfolios. So let's say, for example, we have two stocks which have exactly same weight, but one is weight or score, but one is a highly liquid stock, another one is very less liquid. So we would prefer to select the stock which is highly liquid, because then we can execute it with least amount of slippage. So we do definitely take into account while selecting our stocks.
Perfect. I hope that answers your question, Sahil. Now, Rajesh is asking for the backtested returns. I think we'll be happy to kind of share the different returns in the next update, the next EMA, which will happen the early next month in August.
I think, Eesha, many of these things, I think we might answer it through our blogs or through our social media as well.
Yes.
Because I don't think I like to wait for 1 month. So if we do have these answers even earlier, either through our blogs or through our social media channels, which we are active on Instagram and LinkedIn, we try to answer them. So you might get these answers if you're following our social media handles or blogs.
Yeah.
But definitely next month as well, we'll answer.
We'll share. Yeah. So what I can do is at the end of the session, I'll put in the comments comment box the links to our websites, to our social media handles, and also to gulaq.com, which is our website where we post blogs. So I will put the link to the blog section so that people can track it going forward.
Yeah.
Okay. Then Shrikant is asking for top-up investment, doing it on the day of rebalancing or in the low market days is preferred. I think as Vivek has mentioned previously also, if you have the funds, if you want to do top-up, you should not really wait, because it's very difficult to time the market and be invested if you already have the funds. I think that is what we'd like to say. Then Jitendra is giving a suggestion on showing the list of stocks that you can only show the stocks which were removed, added, and exclude the remaining ones. That would help calming the subscribers. I think for subscribers to feel that, oh, why are the stocks being shown that way?
That's a good idea. We can consider that as well.
Yeah. Okay, the last question is, any idea how much dividends we can expect for Gear 6 in percentage terms of overall investment? Do you have any data available on this?
Frankly, I haven't looked at it ever, because the main idea is to for stock prices to grow rather than to earn through dividends. My guess is that it would be lesser than the dividends from the index. I think the stocks that we are selecting would be giving lower dividends as compared to the index, but that is just a guess. I haven't looked at the data, frankly, and maybe that is something that we would look at and see if we can comment anything meaningfully on it or not. So we look at the data and see.
Yeah. Sure, Vivek. Sounds good. I think 5 o'clock and we're done with all the questions. Sahil just commented that thanks for taking up the questions and appreciate the transparency. Thank you so much, Sahil. I hope it's helped you and all the other subscribers and followers of Gulaq. And I think, we are good to conclude the session. Vivek, anything else you would like to share as closing remarks?
No, I think from our side, we pretty much discussed everything. It's good to share our views, our comments, and thank you for taking out time on Saturday. And the weather is really good, at least in NCR. Thanks a lot to everyone.
Thank you so much, Vivek, and thanks everybody for joining in. We will see you next week, and I'll share all the links with you in case you want to have a look at what we offer, what blogs we write. Okay,
Thanks.
perfect.
Thank you.
Thank you. Thanks, everybody.